Sam, it's great to have you on the show today. First of all, I want to get a sense of what's going on and the dynamic that is, if there's any change in the dynamics for the fixed income market with the oil price now at about 97. About a week ago, we were talking closer to 80, 89, thereabout. And now, obviously, things have changed dramatically. Are we seeing any additional flows from foreign investors as a result, or are they still watching to see how the oil price plays out over the short term?
Well, over the curve, we've seen the fixed income market inching up in terms of yields, and that can be attributed to various reasons. Principally, one of them is the issue around the offshore investors. In the last few weeks or months, we've seen more of a risk-off compared to them bringing in flows into the country. And I think that can be attributed to also a number of reasons: the slide in the oil prices, the global, the European crisis and all whatnot. That had contributed to these offshore players being very cautious in terms of putting more risk into emerging markets and probably the frontier market, of which Nigeria is one.
So would you say over this week, not that dynamic hasn't changed? We're not seeing any more foreign investors with the oil price gaining at least $5 over the last few days?
Well, over the last few days, the dynamic has not changed. With the oil price going to between 95 and 97 now, has really not changed anything. I think the offshore guys will still be cautious. They'll still watch the market. We're looking at a situation where the oil price is around 97. When it was 125, the question is, how much did we accrue to our reserves? At 97, you expect to see non-accrual, and if you look at where the reserve level is now, is slid from 37 billion to about 36 billion. So that alone, the offshore guys will continue to watch the market and see.
But clearly, they would be cautious given what happened in 2008, 2009, where the Naira lost about 25% of its value, and a lot of them were quite burnt. Okay, let's move on to what I'm hearing about Nigeria's version of Operation Twist. We know what the Fed is doing in that respect. They are exchanging long-term papers for short-term papers as another form of quantitative easing. What I'm hearing, though, is that the Debt Management Office is proposing something similar. Can you talk a bit about that?
Well, the Operation Twist, like you rightly said, it was more of a quantitative easing tool used by the Fed. And what they did in that instance was to switch long-dated bonds for shorter-dated ones, put some form of liquidity into the hands of market players. But what is going to happen in Nigeria is not the twist version, it's probably what we call our own switch. And I think it's just the opposite of the twist. What we are doing in this regard is switching shorter-dated maturities into long-dated maturities.
Okay, but why do they need to do this? What I'm hearing, for instance, is that about ₦1 trillion in bonds are maturing next year, and they are concerned about the impact that could have on the financial markets.
Okay, we have approximately $1 trillion maturing in 2013, the whole of 2013. And what the Debt Management Office is doing is part of their liability management strategy to manage their maturities. So what they're trying to do is to switch some of these 2013 bonds into 2017 and 2022 bonds. You see, the way it is, this auction, the switch auction, is a voluntary auction. They've not made it compulsory. So if you have the maturities they're about to switch from, all they ask is come via an auction process. You sell your shorter dated bonds to the government, and the proceeds from the sale will be used to purchase the longer data maturity. So it's a very voluntary auction, and what we see is a very proactive way of the government trying to manage their maturities. And
right.
If you ask me,
you said it's proactive. Sam, you said it's proactive and it's voluntary, but why is it important? Because what I'm also hearing is that if this doesn't happen, we could see yields go higher.
Well, if they don't do the switch and they allow the market, when it matures, to roll over the volume, we're talking about close to 500 billion now. If they do that auction in a single day, trust me, we might see yield crossing the 20%, because it will be a case of too much supply and fewer demand. And you're going to see market players throwing in a lot of speculative bid. So in a bid to manage the yield curve and also manage their maturities, they've introduced the switch, which is a more phased approach in terms of doing an auction. It's a more phased approach, and over time you'll find out that they'll be able to manage the yield properly as opposed to doing it at a single in bulk. And even if you ask me again in terms of the impact of the switch auction, what I see is that it's going to be for create more liquidity in the 2022 maturity and the 2017 maturity, and that has a tendency to also increase yields.
Of course, if we look at those maturities right now, we're seeing between the 2-year and the 20-year yields somewhere between 16% and 16.3%. You're suggesting that we could see yields move over to 20% if we don't see this program coming into play. But what's the update? Because I'm hearing that this program has been talked about for at least 3 months now. Where are we on this?
Well, I think there's been a lot of administrative bottlenecks, but I think they are nearer the end of this bottleneck. And in what the information I get from the rumor mill is that in the next 1 or 2 weeks, you might see them coming up with a new calendar, because the calendar for the switch auction that was given to the market is already expired. So they'll probably come up with a new calendar very soon, and also the calendar for the new quarter. We might see that very soon in the market.
All right, Sam, thank you so much for joining us. Enjoy your trading day. Samuel Ocheho is the Regional Head of Trading at Stanbic IBTC.